Our last chapter, Chapter 14, Retirement and Estate Planning. In a short 2 weeks, we've managed to start with how you get a handle on managing your finances, taxes, credit, purchasing decisions, buying a home and a car, insurance, investing, and we're at the end, planning for your retirement. To begin any plan, your first step is where am I now? Then figure out where you want to be, in this case, what you want to do and enjoy in your retirement. We're going to look at aspects of estate planning. Sounds a bit fancy for many, estate planning, but it just means working out who you want to get what when you're gone. Wills and trust form the basis of putting your wishes into writing so they'll be followed when you're gone. So let's get started. When you're figuring out what you'll need in retirement, some myths need to be debunked. You have plenty of time to save for retirement. False. Start as early as possible to get the benefit of compounding. Saving a little bit will help. You won't necessarily spend less in retirement. You probably won't spend as much on clothes, commuting, or lunches. You probably will spend more on leisure activities, health care, and possibly travel. Retirement may last well over 15 years. 65 to 15 is just 80. We're living a lot longer now. You cannot depend on Social Security and your pension to cover everything. Medicare and your employer's health insurance will not cover everything. The bottom line is you need to start planning on how you're going to supply for your needs in retirement. Key tips. Start saving now. The earlier you start, the more you gain from the effects of interest on interest, time value of money. Use automatic payroll deductions or transfers on a regular basis. Be realistic about your returns. Right now, they're pitifully low. They may get better, they may not. Don't bet on it. Don't touch your savings early, unless you absolutely have to. This defeats the whole point of compounding. Here's a clear example of why starting early pays off. If you start at age 25 investing $127 a month for 40 years at 11%, I wish, at age 65 you'll have $1,092,216. Nice retirement fund. If you don't start saving until age 50, to reach the same $1 million goal, you need to invest $2,244 a month, over 17 times as much. Starting early, even starting small and not touching the principal, pays off big time. Okay, we've debunked the myths and taken a hard look at the what you have part of planning. Think back to Chapter 2, the net worth statement. That's what you need now. Ideally, you've been looking at yours every year, and it should have been increasing. Your home is probably the biggest purchase of your life, and it's probably your biggest asset. If you built up equity, you can consider a reverse mortgage or sell it and downsize, and that's the difference. You can consider reducing your life insurance coverage as you get close to retirement. Your children are grown and hopefully out on their own, so not as much coverage is needed. Some, but not as much with a growing family. The general investment rule is, quote, the percentage of your portfolio you should have in equities is equal to either 100, some use 110, minus your age. The point is, as you get closer to retirement, your portfolio cannot afford to take a hit. You don't have enough time to recover. So you should shift from riskier equities to more stable investments like bonds. Additionally, you're less interested in growth, more interested in income. Expenses may not go down so much in retirement as they'll change. Some will go down. 401k contributions, work and clothing expenses, and federal taxes. But some may go up. Next slide. Both health and life insurance costs may increase. Medical expenses definitely increase with age. You may spend more on leisure activities as you now have more time to enjoy them. And you may want to increase contributions to charity and gifts to your children. Don't forget, inflation will increase the amount needed to cover your expenses, while your income may be more fixed. This pie chart is from the Bureau of Labor Statistics showing how much of their expenditures average older households spend on different categories. The data is from 2011, but probably stays fairly stable over time. Note that housing, 35%, transportation, 14.7%, food, 13.1%, and medical care, 12.2%, together account for 75% of expenses. That's a hefty percent on items that are clearly necessities. After figuring what you're going to need in retirement, we have to figure out where it's going to come from. Major sources for most people: employer pension plans, Social Security or some comparable public plan, personal retirement plans, and annuities. Note, those last two are up to you. A defined contribution plan is one where your employer contributes a certain amount annually. These could be in the form of a percentage of earnings set aside each year and possibly matched by your employer, or it could be a stock bonus plan where the plan uses your contributions to buy stock in the company. This is risky as it may focus too much of your portfolio on the company you work for. Enron should be a lesson to us all. Enron employees lost an enormous amount in their pension plans because it was invested in Enron stock. Profit-sharing plans just mean the amount contributed by your employer depends on the profits of the company. 401k plans have become the most popular pension plan vehicle. A 401k is a salary reduction plan in that you make non-taxable contributions to the plan. Your contributions are tax-deferred, meaning you'll be taxed when you take the money out at retirement, at which time your tax rate will presumably be lower. 401ks typically have a vesting period, which is frequently 5 years. And quite often, 401ks offer employees the option to choose from a variety of mutual funds in which to invest their funds. Fidelity is a major player in this arena, offering a variety of funds with different investment goals and focuses and allowing switching between the funds with no penalty. Defined benefit programs are almost a thing of the past. The name describes how the plan works. You are guaranteed a certain retirement payout based on your pre-retirement salary and years of service. Employers make all the investment decisions, but your benefit stays the same regardless of how the portfolio performs. Portability allows you to change jobs taking your pension plan with you. In academia, TIAA-CREF is the vehicle for this. Otherwise, you would need to roll any funds into another tax-deferred plan without touching it yourself so the tax-deferred status is maintained. ERISA is the Employment Retirement Income Security Act of 1974. It sets minimum standards for pension plans. The federal government ensures part of the payments promised in defined payment plans. The primary public pension plan is Social Security. You pay into it with every paycheck you receive. It is the most widely used source of retirement income as it covers about 97% of U.S. workers. Others may be covered under less well-known public plans such as Federal Employees Retirement System, which covers over 2 million full-time civilian employees, Railroad Retirement Program, and that can be a supplement to Social Security. Veterans benefits are not considered a pension. It is retainer pay as the military can be recalled to active duty. Social Security was never meant to be the sole source of retirement income. It was supposed to be part of a retirement plan. You receive a statement from the Social Security Administration each year showing your earnings record and projected benefits at various retirement dates. 62 for early retirement, full retirement age 66 or 67, or at age 70. You should check this statement to be sure all earnings are reported correctly as it affects your eventual benefits. Depending on your year of birth, your full retirement age may be 65, 66, or 67. It's been increasing gradually to offset longer lives. You can take reduced benefits at age 62, but they remain lower for life. You can also delay benefits until age 70, increasing your benefits for each year you delay. You must earn a certain number of credits to qualify for Social Security, though most who've been working full-time will qualify. In certain cases, dependents may receive benefits based on their parents' Social Security. Check the SSA.gov website for more information. Individual retirement accounts, IRAs, come in two flavors, regular and Roth. A regular IRA allows a contribution of $5,500 in 2016. If you're over 50, you may contribute up to $6,500 as a catch-up. Contributions may be tax deductible. Interest accumulates tax-free until you begin withdrawal. You may start withdrawing at age 59 and a half. You must begin withdrawing at 70 and a half. There's a formula that figures how much you must withdraw each year, and these withdrawals are taxable income. A Roth IRA is a somewhat different animal. Contributions are not tax deductible. Contributions are made with after-tax dollars. You can continue to contribute after age 70 and a half. The contribution limits are the same as for a regular IRA. Withdrawals are tax-free after 5 years if and only if you are at least 59 and a half or the funds are being used to make a first-time home purchase. There are two more types of individual retirement accounts. A SEP, or Simplified Employee Pension, is an IRA funded by the employer that the employee can also contribute to. Contributions are tax deductible. It's intended for the self-employed. A spousal IRA is for a non-working spouse if filing a joint tax return. Contribution limits are the same as for the regular and Roth IRAs. If you change jobs, you can roll over all or a portion of your IRA to another tax-deferred plan as long as you do not touch the funds. An education IRA is also called a Coverdell Education Savings Account. It allows a gift of up to $2,000 each year to each child under 18. These gifts are not tax deductible, but the distributions are tax-free as long as the funds are used for education purposes. And finally, Keogh Plans. Keogh Plans are self-employed retirement plans allowing annual, tax-deductible, but limited contributions. These have historically been very difficult to administer. Personal plans do have limits. You can't leave the money in a tax-deferred account indefinitely, except for a Roth IRA. At age 70 and a half, you must begin receiving minimum annual lifetime distributions. This chart from your text recaps the main details of each of the IRA plans we've covered. In general, you should focus on the first two, a regular or traditional IRA and a Roth IRA. We've looked at annuities when we covered the time value of money. In its most basic form, an annuity is designed to provide regular income for life. Annuity should be used as supplemental retirement income, not primary. Interest accumulates tax-free, but distributions are taxed as ordinary income. An annuity can be structured to begin payments immediately or at some specified future date. Before we move on from planning for retirement, we need to consider, what do you do if your retirement income is not enough? First, be sure you're getting everything that you're entitled to. Make sure your funds are earning the best interest possible. Consider reducing your spending. What about working part-time or full-time? Only dip into your nest egg if it is absolutely necessary. As I mentioned at the beginning, estate planning sounds a bit formal, like a process meant only for the wealthy. It's not. Your estate is just the legal term for everything you own. Estate planning is simply putting together a plan for what happens to your property at your death. In the phases of life, we go from the accumulation phase to the distribution phase. This is the distribution phase. Throughout your life, you are working to build up your estate through savings, investments, and insurance. At your death, you want to ensure that the proceeds are distributed exactly as you wish them to be. If you're married, you need to think about making sure your spouse and any children are provided for. If you're single, you need to be sure your financial affairs are in order. You don't want to leave a mess for others to clean up. To that end, you need to make sure all important documents are accessible and legal, and that your family and attorney either has copies or knows where they are. This slide lists the legal documents in question. Basically, you need to gather all together that are pertinent to who you are and what you own in one secure place. Birth, marriage, and divorce documents, legal name changes, military service, Social Security, veterans, insurance policies, transfer records for joint bank accounts, safe deposit, automobile registration, title to stock and bonds, records related to home ownership and mortgages. So how do you make sure the distribution of your estate is as you want? Wills and trusts. A will is simply a legal document specifying who gets what. It can be psychologically difficult to face the prospect of writing a will. It's an admission that we won't live forever. But it's very important if you have loved ones depending on you for support. A standard will run $300 to $400 and is best drawn up by an attorney familiar with the laws in your state of residence. You do not want your bereaved family to face any difficulties that could have been avoided by ensuring your will is legal. The simplest form of a will is called the I love you will. It leaves everything to your spouse and is usually sufficient for small estates. A traditional marriage share will leave a half to your spouse and a half split among your children. The children's portion and the spouse's may be held in trust, with the trustee managing the funds and the distribution. An exemption trust will leaves everything to your spouse except for a specified amount, which is placed in a trust which can be managed to provide lifetime income. A stated amount will allows you to pass a specified amount to your spouse. The key to having a will is that you do not want to die intestate, meaning without a legal will. In that case, the state decides who gets what, including selecting a guardian for your children. This is not something you want to happen, especially for a blended family. It can get very complicated and contentious. If a will goes into probate, it is being legally validated. You want to avoid this, as well as it is public, lengthy, and expensive. An attorney can advise you on how to structure your will or trust to avoid probate. A will can be in three formats. A holographic will is handwritten, dated, signed by you. Check with your attorney to make sure, because these are not legal in all states. A formal will is usually prepared by an attorney and signed in the presence of two witnesses who are not beneficiaries in the will. A statutory will is one created from a generalized form. Forms are available from a lawyer, in office supply stores, and via software such as WillMaker. Care needs to be taken in using one of these to be sure it includes all the provisions you need, but doesn't include those you don't. Regardless of the format you choose, having a will is very important. As depressing as it may be, everyone should have one, even if it's a simple holographic I love you will. A will needs an executor. Spouses can be executors for each other's wills, but once one has died, the surviving spouse needs to change their will. An executor basically takes care of legally closing down the deceased estate, inventorying assets, collecting any money and paying off debts owed, filing any final federal and state tax returns, distributing the estate per the will. If you have minor children, you need to name a guardian in your will and provide funds for the care and management. Don't forget any pets in the home. They need a guardian and funds for their care as well. Do you remember hotel heiress Leona Hemsley left the bulk of her estate, $12 million, to her Maltese, Trouble? A judge later reduced this to $2 million, but the dog definitely was well taken care of, including living in a Florida mansion with a full-time security guard. Once you have a will, it's not a one-time event. If your circumstances change, your will should change to reflect those events. You move to a different state where the laws may be different. You've sold property mentioned in the will or acquired new property. You've married, divorced, or remarried. Heirs have been born or died. Adding a codicil to your will just means adding an addendum to include or delete provisions without rewriting the entire will. A will describing the distribution of property is not the only will you need. A living will specifies who is to make health care decisions on your behalf if you are not capable of making them yourself. This is where DNR, do not resuscitate, would be specified. DNR means that you do not want to be kept on artificial life support. A power of attorney gives someone the legal right to act on your behalf if you become unable to do so. Healthcare power of attorney combines a living will and a power of attorney into one document. If you go in for a medical procedure, you will likely be asked if you have a living will and possibly asked to provide a copy of it. A letter of last instruction is not legally binding. It's meant to provide your survivors with information, basically your last wishes, your funeral preference, cremation, songs you wish played, specific people you wish to be notified of your death, the location of your will, your bank account, other assets, your Social Security number. This is also where you may want to specify certain items to go to specific people. Quote, Anne has always admired Aunt Emma's brake front and I want her to have it. Trusts are a bit more involved, and you'll definitely need an attorney to set one up. A trust is basically a legal arrangement in which a trustee holds assets in trust, manages and distributes them to beneficiaries as specified in the trust documents. There are significant benefits. A trust can reduce estate taxes. You can avoid probate and transfer the assets immediately. It can ensure that your property serves the purpose you intended and provides income as you wished it to. As with wills, there are several varieties of trusts. A revocable trust can be ended or changed during your lifetime, but does not provide a shelter from taxes. An irrevocable trust cannot be changed once implemented, but does avoid probate and can reduce estate taxes. As we get into more and more involved trusts, it will be more and more apparent why you need an attorney to set one of these up correctly. A credit shelter trust has many other names, as you can see on the slide. Basically, it avoids taxes. A disclaimer trust is for couples who don't have enough assets to warrant a credit shelter trust, but might in the future. It allows the surviving spouse to disclaim certain assets, placing them in a credit shelter trust at that time. A living trust is one that is only in effect while you're alive. Fundamentally, it's a property management arrangement, but has the advantage of ensuring privacy, avoiding probate, and relieves you of management responsibilities. A testamentary trust is established by your will and provides most of the same advantages as a living trust. This would be an option if your heirs are not experienced in financial matters. There's an old saying, nothing is certain but death and taxes. Well, death and taxes go together. Federal estate taxes are levied on the fair market value of property at death. The IRS defines it as, quote, a federal tax on your right to transfer property at your death. There's a $5.45 million exemption as of 2016. Inheritance taxes are levied on property left to a person in a will and paid by the heir. These are state taxes and run anywhere from 4 to 10%. Mississippi does not have any type of estate or inheritance tax. Tennessee stopped levying any inheritance tax as of December 31st, 2015. Taxes on gifts greater than $14,000 given by one person to another in a single year. These taxes are imposed by both state and federal governments. This ends Chapter 14 and our course coverage. Again, I'll go through the chapter summary slides without comment. Sources of retirement income. General estate planning items. Types of wills and trusts. The end of Chapter 14.